This morning, I have Slava Platkov with me of Dimensional Fund Advisors. Slava is a portfolio manager and vice president, currently overseeing $8 billion of investor money and a investment management team of 20. Slava joined Dimensional in 2012, and previously he was working for a large Australian superannuation fund, Sun Super, and a global investment consulting firm, Russell Investments. His experience involves all facets of multi-management, including manager research and portfolio construction. Slava holds a master's degree in applied finance from Macquarie University. He also has a Bachelor of Commerce from University of New South Wales, majoring in finance and actuarial studies. And he is presently also lecturing at Macquarie University, a Master's of Applied Finance. Slava, welcome. Good morning.
Thanks
for
Rob.
Joining me.
No, thank you. Good to be here. Looking forward to this.
Awesome, me too. Now, Dimensional Fund Advisors are a quantitative-based fund manager. Can you talk to us about what is quantitative-based investment management, and can you explain it in a way that my 6-year-old will understand?
Yeah, I can certainly try. And I think there's a bit of a difference between like your typical quant and a systematic, which is sort of what factor investing stuff, which is sort of what Dimensional do. And I think you want to throw traditional in there as well, traditional fundamental managers. And the reason you want to throw that in there is because all of these three approaches, the common thing between them is that they're all trying to outperform. Right, so you can straight away kick the passive management out. You've got traditional, you've got systematic, and you've got quant. If you want to think about how to differentiate the two and to explain what they each do, the two questions that come to my mind are: one is, how do they actually go about trying to outperform? Like, what do they believe in? And then the second one is around what do their actual portfolios look like at the end of the day. And so traditional is the easiest one in that, and the fundamental traditional active managers, as you know, they do in-depth fundamental analysis of companies, and the premise there is they believe in mispricing. They want to look at cash flows, they want to look at prices, and they want to say, all right, is my valuation different to what the market price is, and should I buy or sell as a result of that? Right, that's traditional, and their portfolios tend to be pretty concentrated. They're full of, if you like, best ideas or companies that they know very well, and also their turnover and fees tend to be pretty high as well, relatively speaking. Systematic is, or certainly the way we think about it, Dimensional is fairly similar in terms of to the fundamental managers, if you like, from the perspective in that we also think about cash flows and prices. But where the difference is that rather than thinking about mispricing, we actually use market price, and instead we ask a question: what kind of stocks, what type of securities, using the current price, using the current balance sheets and income statements, tell us something about future return? So we kind of use market price. Are there any characteristics out there that have some predictive power about whether a particular stock or a particular group of stocks are going to outperform in the future? That's where the systematic bit comes in. So what we're after in the systematic land is we're after changes in characteristics. How does one particular security rank on, say, a price to book measure, price-based measure, versus other groups of securities? And what does that tell me about future return, right? And if we can, and that's where, so we kind of turn it around and make it an empirical exercise. So we have some good expectations around what drives future returns. But obviously, if you pay less for something, that's good for return. Or if you're going to generate more cash flow from something, that's good from return. So the expectations are there in terms of what should work, and then it gives us scope to go and do empirical work. Has it actually worked? If I compare stocks on, for example, price to book, and I form portfolios of cheap stocks and expensive stocks, is that going to tell me something about future returns? So then you make it an empirical exercise, which is what which is kind of what we do. In terms of our portfolios, they tend to be plenty diversified, right? Because we are always working with groups of stocks. It's systematic. We're never after BHP. We're always after these stocks with a low price to book or these stocks with high profitability. The turnover of our portfolios tends to be pretty low as well, because these characteristics that we're after, they change very gradually. They're not changing very quickly, so we don't have to turn our portfolios over too quickly. And the fees are pretty low as well. Then you've got the quants, right? The quants, in terms of their portfolios, they're very similar to ours. They're also generally very diversified. The fees and the turnover, it really depends on the type of a quant process that they actually employ. It's across the entire spectrum. You can get the expensive, the high turnover, and you can get the other one. But in terms of where they're really different to us, the typical quants is it's much more scientific and much more rigid. What they're after is they're after kind of looking at past trends or signals and deciding how repetitive they are, and deciding what is the probability of those repeating themselves in the future, and incorporating that into their portfolios. Right. So they're not really after, necessarily price or cash flows. They're not thinking about it from a fundamental standpoint. They're thinking about it, all right, I'm going to analyze a whole bunch of data from a statistical standpoint. I'm going to see if there's a trend. Like momentum is a good example of that.
Are they playing the odds, Slava?
Absolutely, yeah. And
are you not playing odds though?
We're not playing the odds. Absolutely. We're not timing markets. Like I said, we have some really good expectations around what should drive future returns, and their fundamental expectations, value, profitability, those things. And what we're doing is we're making sure that our portfolios are focused on those characteristics at all times, as opposed to quant. They would, for example, they might use similar metrics and they might use similar information, but they might say, all right, rather than just using price to book for value, we might use 6 different metrics, and we might use this set of metrics in this country. We might use this set of metrics in this sector. We might use this metric for maybe the January and February. Maybe we use another metric for the other months. So they're it's very signal and kind of data trend based, rather than sort of the way we approach investing.
And when you look at stocks and you look at these metrics to compare other stocks too, so you said you're not looking for BHP, you're looking for the stock that has these characteristics, right? When you compare the universe, do you look at BHP relative to the mining sector? Do you look at a technology stock relative to the IT sector? Or is it the entire universe? Can you just color that picture a little bit for us, please?
Absolutely, and that's where the empirical work comes in, and that's I guess that's one of the reasons why people think of us as quants, because we have to have an enormous amount of evidence, data kind of evidence behind what we do, and these type of exercises, what you've just asked me, is very much part of that. So generally speaking, we compare a stock versus its country peers. Right? When we build portfolios, let's say an Australian portfolios, we look at BHP versus other companies listed in Australia, irrespective of sector, right? And we've done that analysis. We can control for sectors. We can look at BHP versus other material stocks. The return outcomes you get are very similar. But when you're controlling for sectors, you end up bringing a lot more turnover into your portfolio, because obviously you need to be sector neutral. So the evidence tells us that you don't really need to do that to achieve the same outcome. So we look at BHP versus other Australian companies, and if it's a global portfolio, we look at Apple versus other US companies, and then we put countries together. The reason we do that at country level is because there are different accounting standards between countries. So looking a price to book for a Japanese stocks, you may not be able to. It's not an apples to apples comparison using a price to book of a Japanese stock to, for example, an American stock. So you want to do them within each country, and then you want to put those countries together.
I want to talk about accounting standards later on, Slava.
Sure.
But there's a few other things that I had on my list of things I was really curious about. You've talked a bit about how your process works. How do you look at a company, and where do you actually begin? And how do you start the process of deciding what it is that you actually want to purchase?
Yeah.
And then what do you look at, and how do you decide what you then have to sell?
Oh, absolutely. So the process that we carry out is a daily process, right? And the reason we carry out a daily process because we want our portfolios to always incorporate the most recent information, right? So compare that to an index approach whereby they rebalance once every 6 months, once every 12 months, where, you know, there's an enormous amount of staleness in what those portfolios hold. Our process looks at, I come into work and I think about, okay, what happened to prices yesterday for the securities in my portfolio? What happened to fundamental information of those securities yesterday? Have any of them come out with new earnings, for example? Any corporate actions? Did anyone take someone over? I'm reacting to yesterday's information. And based on the most recent prices, based on what happened yesterday, what is my ideal state portfolio, right? What is the portfolio that will give me the maximum expected return, given obviously the constraints that I've got? And then I have a look. So I've got that, and then I have a look at what does my portfolio look like, and the difference between those two gives me impetus to generate buy or sell orders. Right. So every day I'm trying to move closer towards that ideal state based on the most recent information. So if, for example, a stock's gone up in price, it's all of a sudden less attractive to me. I should consider selling it and reinvesting into something that's more attractive to me, that's cheaper. If a stock's announced new earnings and it's more profitable, I should try to find the money to buy that security. That means I have to go and sell something that's less profitable. So that process takes every single day. And despite and I know what you're probably thinking, Rob. You're probably thinking, oh, that's a lot of turnover. It's every single day. The reality is it's not. There is not a lot in the scheme of things. One day does not make a huge amount of difference to how your portfolio is positioned. There's only so many things that could happen. So I only have to incur very little turnover every day to make sure that my portfolio consistently stays focused on its objective, which is, you know, if you want to overweight value stocks constantly, or if you want to overweight profitable stocks constantly. So it's a small amount of turnover, and all I'm doing is I'm just generating buy and sell orders to nudge my portfolio a little bit towards that higher expected return state. That's sort of how it works.
You mentioned the word information and you mentioned the word prices a number of times. I want to dig into that a little bit deeper.
Yeah.
But before I do, you also talked about selling stocks that are going up, buying stocks that are going down. That's counterintuitive to the everyday investor who wants to buy the stuff that's going up and wants to sell the stuff that's going down. But I take it that your parameters try and remove as much of your emotion as possible, because whether you believe something or not, you're governed by the methodology and the process that your portfolio construction must follow. Am I right in saying that?
Absolutely. So one of the so the process is 99% objective. It's systematic. There is a small element where I could come in as a portfolio manager and make a discretionary call that's better for my portfolio. But even that's within a specific framework.
When was the last time that happened, Slava? And was it a good or bad move?
Geez, you're putting me on the spot here. Let me actually, I'll answer that question as I'm answering the first question as well. So obviously one of the main premiums that we believe in is the value premium, which is essentially buying cheap securities at the expense of expensive securities. And that's where I was coming from when I was telling you that if a stock goes up, it's from a value premium perspective, it's becoming less attractive. So we want to think about selling it and buying something that's cheaper. But that's not all we're doing. Another premium and I'll answer that question now, another premium that's really important to us is momentum. We implement it very differently to value, and there's some good reasons for that. But one of the recent
Can you just explain, Slava, momentum for the benefit of listeners?
Yeah, absolutely. So momentum is where stocks that have gone up will continue to go up. Stocks that have gone down will continue to go down. It is very prevalent in the data. From an economic standpoint, it is a premium that not many people understand. It's poorly understood, and it's a very short-term premium. Whereas a value premium, a value stock outperforms over a 4, 5, 10-year period. Momentum lasts about 6 to 12 months. So if you overweight your portfolio to say high momentum stocks because you think they're going to continue to go up, you're going to have to change that portfolio every 6 months, which is an enormous amount of turnover and an enormous amount of trading costs. The way we therefore implement momentum is we essentially treat it as a friction in the market. And this is where that example comes in. If I have a value security, for example, if I have a security that I own and it goes up in price and I want to sell it because it's less attractive to me from a valuation standpoint, I know that because it's gone up in price, from what I know about momentum, it's likely to continue to go up in price, right? So I want to make that decision, and that's also a systematic decision. But I want to make that decision. I want to make a trade-off. I want to ask myself, what is the right thing for my portfolio right now? And what the way we look at it is, because we're always working with groups of securities, and there's always group of security that's gone up in price that I want to probably sell out of, and there's always another security that I could sell out of. I will not sell that security that's got a high momentum associated with it as well. I will delay that decision. I will let that security run, earn that final little bit of return, and then reassess tomorrow or reassess next month, because I've always got other securities that I could sell. And one stock that comes into that place in our portfolio in a big way, in our Australian portfolio, is Fortescue Metals. That security has been on an amazing run, and we've been overweight that security because it was fairly cheap when we bought it, obviously, and it's very profitable as well. So it ticks a lot of our boxes. It's gone up on an amazing run, and it's now a really significant overweight. And while we want to be selling out of it, there's that momentum bit that comes into it because it's still going up. But because it's such a large overweight and because it's such a large part of our portfolio, there's actually conversations that are ongoing within the team thinking about, all right, mate, despite the really strong momentum characteristics, maybe we should trim a little bit because it's now becoming a bit of a significant position in our portfolio. So that's a scenario where, the process is 99% systematic, but there's scope for portfolio management team to get together, have a conversation, think about what's the best for the portfolio, and intervene if need be. And that's another really important feature of I guess systematic investing. The way we do it at Dimensional is that it's not an automated process. There is a driver at the wheel, making sure that every step of the process is carried out properly, and if need be, and there are many scenarios where we needed to intervene, like coronavirus month of March was one example of that. There is a very experienced team that can come in and make the right decision. So that's really important as well.
With the enhancements and advancement of technology, do you feel as though information is being reflected in prices the fastest it has ever been in decades gone?
Yeah, we get asked that a lot. Obviously, like I said at the very start, one of the main pillars of how we approach markets and how we invest is our reliance on market price. And so we have to have an enormous amount of confidence that the markets do a good job incorporating information into the price very, very quickly. And there's numerous tests that we've done to test that. One simple one is and there are quantitative tests to do this, but one simple one for the listeners is like, just think about the month of March, how violent the markets were, how they've fallen sort of 35-40% over a 3 month period of time. An enormous amount of new information that investors just have never experienced was coming into the markets every single day. And what was happening was markets were going up 10%, falling 15, going up 7, falling 4. That's a sign that new information is coming in and markets are reacting instantaneously. One other more of I guess an extensive test of that is active manager performance study, because if you pose a question where markets are not efficient or markets don't do a good job incorporating information, and there are opportunities to profit from that, then who should be the group of people profiting from that? It should be these active managers, because they're very smart, they're very educated, they have very experienced, and they're very motivated to profit. That's the business, right? And what you see is that you see over a long period of time, you see the vast majority of these managers underperform. like something like 70% of these managers underperform their respective benchmarks, and we've got some really comprehensive studies that show us that. So that's another, I guess, sign for us that markets are, do a very good job incorporating information to prices instantaneously. Very difficult to find mispricings consistently.
Over the years, there's, especially the last few, we've seen investors move significant amounts of money from the typical active fund management to indexing, factor-based, smart beta, etc. And especially a lot of younger investors that we speak with, no one's talking about active fund management. No one.
Yeah.
Everyone's talking about, should I go and buy that Vanguard ETF and just put it in the bottom drawer? Why do you think that's the case? And do you also think that with the sheer number of now products that are hitting the market, is that beneficial to investors, or is that just, confusing investors as to where to allocate the money? So 2 questions there. There's is it good for investors, but at the same time, can it be confusing?
Yeah, I think it's good for investors. I think there's more and more advice out there. Obviously, you have a lot more access to just good information about what investing is all about. You don't have to be a finance educated to look at some returns. And the fact of the matter is, like, a market portfolio deserves a lot of respect. It's giving you, US is the longest set of data we've got, going back sort of 90 years. It's giving you 10% per annum. Obviously, it comes with volatility, but it's giving you 10% per annum on average, and it's diversified, it's transparent. You know exactly how it's constructed. You can generally access it at a very low fee. It's got low turnover. So there's a lot of very good things about a market portfolio. It deserves respect. You need to have a very good reason to deviate from it, right? And that's definitely part of the reason why there's been so much money going into passive. And also the underperformance of active manager as a cohort as well is another reason. But there's still, I think 50 or 60% of the overall invested capital is still with active managers. So it's still a very dominant part of the market, despite the trend very much being towards that passive state.
Is that because of big superannuation funds, big institutional money that is skewing it that way?
I think superannuation funds, we certainly got a lot of clients, institutional clients. Most of them are still very active minded, but they are becoming a lot smarter in terms of how much money and how much of their overall portfolios they want to allocate to active, because like I said at the start, it does come with a cost. It does, it's so they do generally what an institutional client would do now, and they're very sophisticated investors. They would have a core of their portfolio with an index or an index-like approach, and then around that they will spend their kind of tracking error and fee budget on some of these higher octane managers that they still, but the active managers is still very much alive, and people still believe in that whole proposition. I think just because of some of the underperformance over the last 20 years as a group, and obviously the technology, you mentioned ETFs, and just an easy access to some of these products have really led to this trend of investing in these products.
Do you think by taking that point of view and that stance, you've got a lot of investment consultants and asset allocators justifying their role by allocating money to active management, and you've got a job of trying to not only pick the asset class, but then pick the manager that's going to outperform? And do you think that if people don't do that anymore, then there's some aspect or an element of, what am I actually doing here? What is my role?
Yeah. I think there's definitely an element of performance chasing in the market. I don't think consultants are necessarily the guilty party, though. They definitely the natural kind of view for them is to have a manager that's active and they're changing their portfolio a lot, which gives them obviously an opportunity to analyze it and then to relay that analysis to their clients. It's kind of a natural playground for them. But they're also, they've got fiduciary responsibilities. A lot of these people have been around a long time. they understand all the trade-offs around, you know, tracking error and fees, and ultimately I think they want what's best for those portfolios, for the clients that they advise to, consult to. And I think a lot of them, you know, rate our funds, for example, very highly, and a lot of them rate Vanguard funds, for example, very highly, even though they're just passive solutions. So I think they're smart and they're sophisticated enough to make the right decisions for their clients. So it's not necessarily like, oh, I only want to rate active managers because they are changing things all the time and it's a really cool conversations and I could sell that to the client. I think they're better than that.
I always find very amusing ratings and research that rate passive index funds as just recommended. Like it actually just baffles me how that came. But anyway, I'm obviously not a smart.
I used to do some of these ratings when I was at Russell, not index funds, but just generally. And we there was definitely look, you need a criteria, and that criteria performance has to be just one part of that overall criteria in terms of how you rate a manager. A lot of the other things come into play there as well, and that hopefully prevents you from chasing that performance and as a result making the wrong decisions.
Before I change gears, has there been a stock, or can you just tell us a time when you've just got so excited about something, you want to include it in that 1% part of the process, but you just can't? But there's something that's just gone, you're like, I want to get that in the portfolio, but you haven't been able to because it doesn't tick a whole bunch of other boxes. Can you give us an example of that?
No, it's never that way. It's never that way. Like we have no emotion essentially when we're managing portfolios.
You're a human being, Slava. You have emotions.
Well,
you
it's
have
all
biases.
rules. It's all rules based. If anything, Rob, it's the other way around. It's more like, for example, a good example is some of the airline companies at the moment. So, we use profitability in our portfolio, so we tend to overweight high profitable stocks at the expense of low profitable stocks. The metric we use is operating profits on book. So we compare companies on that metric, which gives us information about, the return in the future. So a company that ranks well is likely to outperform in the future, right? So we rely on that metric to have that forward-looking information aspect with it, right? And we've done that analysis, and it generally does on average. So that's great. But sometimes you're in a scenario where clearly that metric, operating profits on book, is not reflective of future profitability. Where that company sits in the rankings is not reflective of the future. And that there's a couple of reasons behind. It's just simply an accounting. It's a fundamental issue. And some of the airlines came into play since this coronavirus, because on some of those metrics, on some of those profitability metrics, they're still ranking quite attractively. But clearly their businesses are not doing too well, and they're probably not going to be doing too well in the next 2 to 3 years. So this is an opportunity where, as portfolio managers, again, using that experience, we have to come in and say, all right, quant is sitting here on that ranking, which means it should be that footprint of our portfolio, but that's clearly not right, because we don't think, we think it's going to change very quickly in terms of that profitability number for quantas. So this is an opportunity for us to, review that and adjust it if need be, and make sure we, again, make the right decision for the portfolio.
I want to get into that shortly, but before we do, the Australian stock market has 2,181 stocks with a market capitalisation of around $2 trillion.
Yeah.
And this is data from a couple of nights ago when I was looking it up. The All Ordinaries, which roughly the Australian All Ordinaries, which basically captures the top 500 stocks in Australia, makes up 1.93 trillion of the 2 trillion. So top 500 stocks basically make up 98% of the 2,181 stocks.
Yeah.
And can you talk to us about the concentration of the Australian market? Can you talk to us about how top heavy we are? How much of that is top 10 compared to the top 500? And is this actually just an Australian thing? Because everybody talks about the Australian market is small, it has no breadth, it has no depth. But is that only an Australian phenomenon, or is it actually something that's consistent globally? Can you give us some insight into that, Slava?
Absolutely, absolutely. And so there's, as you said, 2,000 stocks. Investable universe in Australia is around 450 stocks. And when we're saying investable, we mean stocks that we can, invest in a liquid way, right? So there is a huge tail of companies that are just listed, but there's just not a lot that you could do with them. It is a top-heavy market, so the top 5 names comprise nearly 28% of the market in Australia. And top 10 names 40%, top 50 names 75%. So it is a top heavy market, but it's no different to many other markets around the world. That concentration, that concentration within the top few names, that's been around for decades in many different countries. The US being one example. At the moment, the top 5 names in the US are 22% of the market as well. Right, and historically that's been the case. So it's not. It is top heavy. There are some very specific nuances to the Australian market. We've got this huge allocation. We've got these 4 banks that are very similar as businesses, and we've got this. So the financial sector is really large. We've got these materials. We've got BHP and Rio, which are very large as well, and we've got this REIT market as well, which is a lot larger than the rest of the world, significantly larger than the rest of the world as a proportion. But it's no different to many other markets in terms of its concentration. And what that conversation leads to is thinking about, when you're constructing portfolios, how much of your home bias should you have, and how much should you allocate outside of Australia?
Home bias, you mentioned. I read a Vanguard research paper recently that talked specifically about this topic. And I think based on Vanguard's numbers, and we see this as well when we meet with prospective clients, and they say, here's the portfolio, here's our super fund, here's our trust. We find that it's a mishmash of Australian stocks, and they claim to be diversified because they're holding 3 of the 4 banks. They've got 4 different mining companies. It's the classics, right? It's basically a fragmented index that they've created, and it's a large portion of their stock allocation.
Yeah.
Vanguard's research showed us that 65%, I believe, in Australia, of an investor's stock allocation is invested domestically.
Yeah.
Is this home bias concept, again, is this a global phenomenon, or is it just an Aussie thing that Aussies love investing in Aussie stocks?
It's definitely a global phenomenon, but you've got to take into account the fact that Australia is 2% of the world. So there's even home bias in America, despite the fact that US equities is 65% of the global market, and you still have US investors having 70 or 80% in their portfolio in US stocks. So there is that home bias is prevalent across the world. The issue is with Australia is that Australia is a very small part of the world, so it's much more pronounced. So yeah, we've also done this type of surveys with our investors, and what we find is that 60%, on average, 60% of an investor's equity portfolio is invested in Australian stocks, which is 30 times home bias, if you like. And we think at that level, it presents a lot of concentration risk to the portfolio. There are some good reasons to have home bias. That's why it's so prevalent around the world. In Australia, in particular, with franking credits, there's some good reasons. Those reasons are difficult to quantify because a lot of them are behavioural. Like in Australia, for example, one reason is the fact that you're earning money in Australia, so you're linked to the Australian economy. So the Australian market is very much a good reflection of that. So that familiarity, interaction, if you like, that's a good reason. But how do you quantify that? How do you come up to a number that tells you, all right, you should have 10% home bias or 50? Very difficult to do. There's a lot of research on this area as well. The way we approach it at Dimensional, because we manage some balanced funds, and the home bias that we have is 36%. The way we manage it is we kind of say, all right, what is the most diversified position that you can get to? And that's really just that market cap weighted global index. If you look at all country weighted index, IMI, so emerging markets, developed markets, large caps, small caps, the entire universe of stocks out there, that's the ideal state, if you like, from a diversification standpoint, right? That's what you want to lead to because that's the best portfolio you can have. Then, all right, and then we say, okay, if you've got 60% home bias, how far away are you from that state? And the answer to that is very, very, very far away, because if you've got a 60% home bias, for example, you're looking at a portfolio that has 27% in the top 10 stocks, and all those 10 stocks are Australian stocks. And you've got more of your portfolio in the top 10 stocks than you've got in the whole of the US, right?
Are you saying that the ideal is 36% in your world allocate? What was the 36%?
30% is what we use as a number in our
to
world
allocate
That's
to
our
Australian
home bias, yeah. So if you look at our World Equity Trust, for example, 100% equity portfolio, 36% is going to the Australian portfolio. So that's a number that's much lower than your average investor, but that's a number that we're comfortable with, in that you're getting some home bias, because there's, like I said, there's some good reasons for that, but you're also end up at a portfolio, particularly if you're using dimensional portfolios, which tend to be underweight large caps, overweight value, and they tend to be a lot more diversified than indices. Then you get to a portfolio that's got 20% in the top 10 names, 40% in the US. You get a portfolio that is very, very well diversified across different industries. So you get away from that financials and materials. You get a whole bunch of healthcare, you get a whole bunch of IT in your portfolio all of a sudden. So it becomes, again, it's not a scientific exercise. It doesn't have to be. It's just a matter of looking at your portfolio and thinking, all right, how diversified is it? How well represented is it across stocks, across countries, across sectors? And we think at that 36% home bias, it's a much better outcome than the 60% that the average investor has.
I think a lot of it has to do with familiarity and investors' appetite to invest in something they're unfamiliar with. So the first decision they've made is, I'm going to invest in stocks. How can I mitigate or minimize this risk? I'll invest in things that I know.
Yeah.
Maybe not knowing that actually what you're doing is you're taking a much higher level of risk by concentrating your portfolio. So I think a lot of it has to do with that, what people are feeling comfortable to do.
That behavioral aspect, isn't it? Yeah. But then again, like, why wouldn't you? And this is where the advice is really important, right? Because guys like yourself, Rob, it's a simple conversation. Like, why wouldn't you want to have exposure to Amazon? Why wouldn't you want to have exposure to Microsoft? Like, these are
and I think the last 10 years have, and I think that it'd be remiss of me to ignore the technology stocks that I want to touch on for a couple of minutes. Yeah. And this is not a COVID phenomenon. These stocks have been on a tear for a number of years now, although probably more pronounced now than they previously were. And in fact, if you hadn't invested in in US growth-orientated stocks for the last 10 years, it actually doesn't matter where you invested your money. You're behind the eight ball every single time. What do you think? What lesson do you think investors should take from that? I feel like we've answered that partly with global allocation, but what are some of the other lessons do you think investors should take from these learnings over the course of the last 10 years? In fact, it's since the GFC.
Yeah, absolutely. They've gone on an amazing run. I was reading something just this morning that said FAANGS have accumulated a return of 35% per annum over the last 10 years, which as a group, which is quite incredible. If you were standing 10 years ago though, and you were asked, are these high expected return securities? Is your expectation that they're going to earn 35% per annum the next 10 years? The answer would have most likely have been no way. But that's markets for you. Like this, the realized returns are unpredictable. It's very difficult to predict market returns, and these themes, these long cycles of similar-ish companies becoming innovative, and the products that they're putting out in the market are really popular, and they're just becoming more profitable. That's been around for decades, right? And we have to go back to things like IBM in the 50s, or AT&T, but in the first part of the last century, right? Or General Motors, right? Like, think about the airbag and the automatic transmission, right? These were the FAANGS of those decades, right? And they were huge companies, and their prices were very, very high. They were very expensive on any valuation, but then these cycles finish, and now it's this. Now it's the Apples of the world, and that's going to finish as well at some point. There's going to be new things out there, so it's not uncommon that these cycles take place in markets. This small group of companies perform really strongly. That is quintessential growth investing following this kind. And then, but what we know is that over the long term, value companies outperform. What we don't know is when that happens, when that bubble bursts, if you like. We don't know. It's very difficult to time these markets. But what's happening right now is, in terms of just the broader theme, is no different to many other times we've seen previously.
I saw some research that looked specifically at this, and it may have been Dimensional's research that looked at top companies that make up top 10 since, I think, 1930, 1940. Yeah. And you see Avon, you see AT&T, General Motors, General Electric, ExxonMobil, who just got kicked out of the top 10. But a lot of these companies, once they make the top 10, they hang around for a long time. So it's not as if they make the top 10 and then they all of a sudden fall away. But what I wanted to talk about was, once they make the top 10, sure, they might hang around from a market capitalization perspective. Yeah. But the future returns are not actually that good. Yeah. They're quite lousy. Do you know what some of those numbers are?
Yeah, absolutely. I do. So if you draw a line at the point of a company entering the top 10, right? If you draw that line and then you look back, how did this company perform to get into the top 10? Obviously, that performance is going to be amazing, right? The company would have outperformed the market. I think over a 10-year period, I've got these numbers here, the company outperformed the market by 10% per annum over a 10-year period before it got to the top 10, to get into the top 10. From there onwards, the subsequent return, which is really what investors are primarily concerned with, right? No one cares about the past. We want to know what's going to drive returns in the future. The company in the top 10 has underperformed the market by 1.5% per annum over the subsequent 10 years, right? So that's something that we've seen. That's the analysis that we've done. So, and our portfolios, our typical core portfolios that tend to overweight small cap, value, and profitable securities. We try to actually maximize return across that entire cycle. So as the portfolio is entering the top 10, as it's going up, we've got things like profitability and momentum working for us. Once it's in there and it's starting to come out, we start to increase our position, whereas it's starting to underperform, it's becoming more attractive from a valuation standpoint. So there's different characteristics that are in play there, and our portfolios tend to adjust to make sure that we are well positioned to capture all those changes in characteristics. So
I guess it goes back to the price you pay for a business or for investment. The more you pay, the less your future expected return. The less you pay, the greater your future expected return. But I think investors have this. I mean, we all have this recency bias that we look at what's happened most recently, we project that out into the future, and then our expectations are anchored to what had happened. Yeah. And if the future deviates from that, we're disappointed. Yeah, on the downside. Right. If it's beyond that, we're obviously not disappointed, and we're quite pleased with the result.
That's right.
You've been talking quite a bit about value. Let's talk about that. Let's talk about the rise of intangible assets on companies. Well, I'll say balance sheets, but if you asked an investor 20, 30 years ago, what was the most important thing about looking at a company's metrics or valuation, they would have said earnings. What is the company's earnings? Because that's what you're paying for, right?
Yep.
But what we've been seeing over the course of the last 10, maybe 15, I wouldn't quite say 15 years, maybe the last 10 years, we're seeing this rise of some intangible value that is incorporated in companies. And what used to be a line item on the profit and loss probably shouldn't be sitting on the profit and loss. What should be sitting on the balance sheet probably shouldn't be sitting on the balance sheet anymore. And then your bottom line is this mix of cash flow and balance sheet items that is really, I feel, making it difficult for people to place values on these things. So, we use brand name as an example. We use
Yeah.
companies' distribution lists, for example,
Yeah.
R&D, a whole variety of things. And we can probably go on forever and talk about intangible value. How are you looking at intangible value
Yeah.
and using that number to put into your formulas for it to spit out something for you to then say, this company looks attractive or this company does not look attractive?
Yeah, absolutely. And it's been prevalent. This whole conversation has really been around the last 5 years, where the value premium has been particularly challenged, because where it comes from is the premise there is that if you're using something like a price to book, which is probably the most commonly used value metric to compare companies on, that reported book value doesn't include those internally developed intangibles that you're talking about, things like trademarks, copyrights, patents, franchises, computer software, things like that. If you were to include those things into the book value, then price to book number would be lower. So those companies, they appear growth expensive, but if you include those intangibles, that ratio goes down, so they become much more attractive from a valuation standpoint. So that's the argument. That's the argument saying, all right, this is actually not a growth company; it's a cheap company, because it's got this huge off-balance sheet balance of internally developed intangibles, and we've done an enormous amount of work on that. And First of all, it pays to understand exactly what intangibles are. We just spoke about that, but then there's also externally developed external intangibles too, which is goodwill, which has a market price to it, and that market price gets assigned to it through acquisitions, right? When you buy a company, you are paying more than it's worth, and that difference becomes goodwill. So that's a really good process that's been around for a very long time. Internally developed intangibles like trademarks, copyrights, they've also been around for a very long time. Like Mickey Mouse is an intangible for Disney since the 50s, right? It's nothing new in terms of what those things are and how they get accounted for. The issue is, as you're saying, is that now some of the very large companies in the US, but in particular, have these, and this is particularly specific to the US accounting rules, have these large off-balance sheet balances of internally developed intangibles. And as I said, the challenge there is, how do you value those? And it's very difficult, because there is no good market mechanism. There is no good competitive mechanism that puts a price on those things. There's a lot of research written on how these things should be valued. The most known methodology is looking at R&D, so looking at a company's financial statement and looking at the R&D expense and the selling and general administration expense, and accumulating those, because they represent intangibles. And then if you want to adjust your book value with that number, that's kind of one methodology that you could use. If you use that methodology, our research shows that the difference in performance, it would have been a little bit better in the last 10 years, because obviously the large companies would have made a difference. But over time, it's really wouldn't have made much of a difference at all, from a portfolio standpoint. The other thing is, one of the reasons why it wouldn't have made a difference, because you also want to use, you also have profitability. So for us, we use profitability as operating profits on book. So if you're making book larger, all of a sudden that company becomes less profitable. So you want to increase its weight because it's becoming cheaper, but you also want to decrease its weight because it's becoming less profitable. So net, it's actually not changing much in your overall portfolio. So all the research that we've done shows us that, if you adjust for intangibles, it's very tricky thing to do, because there's a lot low transparency how these things are valued, and there's a lot of complications around how you adjust the book value with those numbers. But if you go ahead and do that, and you still run your portfolios the way we've been doing, where you're using value and profitability, the net outcomes is pretty meaningless.
Do you think that accounting standards need to be adjusted to account for something like this globally?
They're different globally, Rob. Like in Australia, we've got IFRS. In the US, they're GAAP. So IFRS is very different. We actually don't have that problem, this intangibles problems in accounting in Australia, because in Australia, what companies are able to do is, if they do incur a lot of this, if they have a lot of, for example, patents or software, for example, off balance sheet, at every year, an Australian company can have a look at that balance of patents or software and say, all right, how much of that has actually eventuated in profits? And they could then capitalize that amount, right? So in Australia, if you have a look, the off balance sheet intangibles balances are very low. So it's just because of the accounting standards are that way. So it's, again, and that's another, if you're running global portfolios and you all of a sudden want to account for intangibles, how do you do it? US has this standards, Australia has this standards. Like, what do you do in a global portfolio? It makes it very difficult. And that's why there's been a lot of conversations about intangibles and value, but you haven't seen many managers actually do any adjustments. Generally speaking, what managers tend to do is that they tend to use multiple metrics rather than just price to book. They use price to earnings and price to cash flow and price to sales. They combine those, and that kind of diversifies out that impact. And that's exactly what we do as well at Dimensional. We use price to book and profitability, which is kind of the equivalent, if you like, of using that multiple metrics approach. So that's the short of it. But it's an area of an enormous amount of research, and we've done a ton of it. And it's been something that clients have been asking us a lot about, mainly because of negative value premium, and that negative value premium over the recent past is driven by this large group of companies that have large balances of internally developed intangibles.
How do you respond to investors or money managers who say price to earnings, price to book, what those metrics are telling me about the next 12 months about that company is absolutely meaningless and useless to me. Yeah. I'm looking at the future cash flows of that company beyond the next 12 months. So those metrics, throw them in the bin because they're absolutely useless to me. How do you respond to that?
Well, what we've seen is whether the value premium has been negative or positive, the explanatory power of those metrics has been super strong. It stayed the same for decades, right? So it's a good signal of what drives returns. The realized premiums are obviously very volatile. So it really doesn't matter what metric you use. You get the value premium irrespective of what you divide price by. The key, and that's also important for the intangibles conversation too. The key is the price. You want to find a metric that gives you the purest possible signal on a low price. You obviously have to divide by something, right? But that's really what the point of the value premium is. Low price, high expected return. All those metrics eventuate in the value premium. We use price to book because book value is the most stable of the lot. It doesn't change as much. So that leads to low turnover portfolio. So it's an implementation decision, but we can just as easily use price to earnings, price to cash flow, or price to sales, or a combination of them. It works fine. If you use price to book and you've got profitability on the other side, which is a non-price based metric, it's a metric that doesn't change as quickly. You put those two together, you find companies that are cheap and also profitable. That is an incredibly powerful combination, and that research is undeniable.
In the late 90s, Warren Buffett was absolutely crucified for not owning any tech stocks. And, I've watched a number of the Berkshire Hathaway AGMs during the late 90s. And it's interesting, a lot of the parallels you can start drawing to the era that we're investing in now. It was said that Warren Buffett has lost his magic touch. He's all washed up. He's never going to make money again. Are we seeing deja vu, or has the value spring compressed so much over the last 10 years that no, it's actually not going to spring back and it's just going to break? Because there are only two things that are going to happen. It's going to spring back or break. What's Slava's point of view on that?
We're very confident that it's going to spring back. What we don't know is when. The dispersion between growth and value, particularly in the US, is as wide as it's ever been. So it's been a painful experience for investors in value, that's for sure. Not too dissimilar to what happened during the tech bubble. We were there, like Dimensional were around, right? We had our kind of flagship portfolio in value coming into 2001, coming into that burst, was underperforming its benchmark by 5% per annum over a 10-year period. So it's like a cumulative 60% underperformance. And they got all of that back and then some within 18 months after that bubble burst. We hope that that's going to happen again, obviously, but the reality is that we don't know when it's going to happen. But we do. But look, for us, you always go back to that valuation equation, that it's prices and cash flow. So long as companies have different expected return, you should always expect the value premium. You should always expect the profitability premium. We understand that these premiums are very, very noisy and very volatile. That's why we are not trying to time them. We're trying to keep focus on them all the time, and we hope that it comes soon, but we're confident that it's going to come.
The rest of that story unfolded something like this. After the tech boom and tech wreck, Berkshire Hathaway just went on an absolute tear, having invested in value stocks, and just left everybody in the dust, which is quite interesting. I'm going to wrap up, Slava. I've got one final question for you. We are in the year 2023. What has been the investor's biggest regret?
Not doubling down on value, I'd like to say.
Why didn't I expect you to say that?
No. Look, it's as you know, with Dimensional, we're not in the business of forecasting. Look, I hope that, you know, it has been a challenging couple of years. I think our portfolios have achieved pretty good outcomes considering the challenges that we've had in just the broader environment. I do hope the value bounces back, because it's good for our investors at the end of the day. Yeah.
All right. This is part B of this question. Do you ever go to sleep and think, shit, I really wish we had exposure to FAANG?
We do have exposure to FAANG. We're just underweight. We absolutely have, and some of the FAANGs we have a pretty good exposure. Like, we're not that underweight because they are profitable. So yeah, like we've got our core portfolios invest across the board. We own plenty of Apple, plenty of Microsoft, plenty of Facebook. We're just underweight. But look, the thing is, those companies have grown to be so large, such a big part of the market, that it's mathematically, it's not going to take much of an underperformance from those stocks for the value premium to come roaring back. And I would really like the last sort of 6 weeks, we're starting to see some offshoots of that happening. So it's not, I can't put my hand on heart and say this is definitely the start of a turnaround. We don't know. But what we see is that if all of a sudden Amazon falls by 5%, that's a very strong day for our portfolios. Yeah. Right. So they're just
Apple's
so large.
down 22% over the last few weeks. So we are starting to see some turnaround. Slava, absolutely love the conversation. Thank you so much for joining. Maybe we'll have you back on again to talk a little bit about this when things have turned around, and maybe we'll have a different conversation. But thanks again. Enjoy the rest of your day, and we'll chat again soon.
I appreciate that. Very good to talk to you, Rob. Appreciate it.
Thanks, Slava.
Thanks.
Bye for now.
Okay. Bye-bye.